Good afternoon, everyone. Namaste. My name is Sriram from the Commodity Research Desk at Reliance Securities. Welcome to the weekly market updates for commodities. So, beginning with the bullion side of things, international and domestic gold and silver futures rebounded from last week lows and eked out small gains for this week, especially in the second half of the week, where the dollar and the treasury yields remained slightly sluggish. However, earlier in the first half of the week, the FOMC minutes was released, which showed that most members continued to see significant upside risk to the inflation, which could further tighten the monetary policy stance by the Fed. Some members did cite that there could be a significant risk to the economy due to the higher rates, but agreed that level of uncertainty remained high for the inflation side, and future rate decisions may depend upon the incoming data. The incoming data has been robust. The recent labor market data reported that the number of Americans filing new claims for the jobless benefits fell in the last week, suggesting that labor market is still tight and could prolong the Fed's job to cool the economy going forward. So that kept the prices upside very limited this week for gold and silver. Looking ahead, in the coming week, the key trigger will be the speeches by several key Fed, several central bankers this week. Of course, we have the Jackson Hole Symposium, where Fed Chair Jerome Powell and ECB Chief Christine Lagarde are scheduled to speak. Of course, the Bank of England Governor Bailey is also expected to speak on the monetary policy, and that will be the key trigger for the gold and silver prices this week. Of course, most investors believe that inflation is still has come off recent highs, but it may not be low enough, and some market expectation on inflation has recently spiked due to the elevated crude oil prices. So this could be confirmed by the Fed chair in this week in his speech, and he will continue to reiterate that the Fed could be data dependent. Incoming data will decide on what the Fed might do in the month of September. So overall, this uncertainty ahead of that will keep the prices upside limited, and in the short run we see possibly more sluggish activity for gold and silver. Apart from the major event, Jackson Hole Symposium event, on the data front, we have the housing numbers this week, along with durable goods and with the jobs numbers also, with the jobless claims on Thursday will be a key trigger for the markets this week. So on the charts, we feel domestic October contract can remain within a broad trading band of 58,000 to 59,000, while internationally we see a range of 1875 to 1935 this week. Moving on to crude, as I mentioned earlier, crude prices remained elevated, has been over the past few weeks, but this week markets witnessed some correction amid some profit taking. Of course, there are concerns about weak global growth, especially the top importer China has remained economic activity in the top importer China has remained sluggish, and that kept the upside limited. Of course, some support came after upbeat, stronger than expected manufacturing PMIs from US and Europe reflected firm demand from the top economies there. But that upside was capped after progress was made between Iran and US relations. That definitely led to higher crude exports from the country. According to the tankertrackers.com website, Iran crude exports rose around to a 5-year high to 2.2 million barrels per day during the first 20 days of August. Especially China has been the big buyer for Iran crude, and that kept the overall markets remaining on the sluggish side of things, or I should say the upside remained capped even though exports have risen from Iran. We can expect more supplies from Iran, and that can offset some output cuts by the OPEC cartel, but overall we see markets remaining range bound. Possibly consolidation can happen after a big rally over the last few weeks. So we see markets remaining range bound in the coming week. On the inventory front, we have the IEA data tonight. Yesterday night, the API numbers showed a big draw of 2.4 million barrels for US crude oil inventories in the week ending August the 18th. So that has definitely limited downside. but we see markets will be range bound this week. Key triggers again will be the speeches by several central bankers this week. Additionally, last week the US EIA projected higher output for the US. EIA projected output at 1.7 million barrels for the week ending August 11th, and that remained slightly on the upside. That has actually capped the upside for the market. So another higher projection for US crude oil output will definitely keep upside limited. So we have to wait and watch what happens. Of course, the key central bank meeting or speeches this week will be a key trigger. The Chinese demand also will remain a key trigger. Activity has remained sluggish from that country, and further sluggishness can weaken demand going forward. So markets can remain range bound ahead of that. On the charts, we feel markets could remain in a broad trading band of 77.50 on the lower side to 82.70, 82, $83 for the NYMEX crude. Domestically, we see a big range of 6,500 to 6,800 for this coming week or so. Briefly on natural gas prices, internationally and domestically struggled last week and continue to struggle this week as well, weighed down by cooler weather forecast for the US over the next couple of weeks. And we see markets can remain range bound to slightly on the weaker side. Bias can be negative, with weather continue to playing a key role for the demand side of things, and further cooler weather predictions can keep upside limited for gas prices. So overall, possibly more correction can be a possibility. On the charts, we see $200, 200 rupees on the domestic side can be tested going forward this week. Finally, on the base metal side, the base metal complex earlier in the week struggled as new data from China amplified concerns over the country's economic recovery and further paired the outlook for the base metal demand in the world top consumer. However, Beijing took active steps and cut key policy rates to shore up activity last week. The PBOC unexpectedly slashed the one-year medium lending facility rates by 15 basis points to 2.5%. Also, the one-year LPR rate was also cut this week ahead of the key events in Jackson Hole Symposium. It was cut smaller than expectations, so that has definitely dampened sentiments amongst investors. They say that the country, of course, did take active steps, but the 15 basis point move or the cut disappointed the market forecast and indicated that the country had limited room to ease the monetary policy further. So we see further correction for base metals going forward in the coming week. Concerns of slowing demand in China, of course, and rising US interest rates will be a key trigger or negative trigger for the markets. But the concerns are also worsening for the real estate crisis in China, which major developers are facing debt defaults due to the slowing sales and construction. So overall, China continues to struggle going forward and will continue to struggle going forward in the next few weeks, and that could dampen demand for the base metal sector going forward. So we see more correction in store for the base metal complex in the coming week or so. Of course, the Fed Powell speech on Friday will be a key trigger for the base metals as well. So all eyes will be focusing on that. So markets could remain range bound ahead of that. Domestically, we see a range of 715 on the lower side to 750 on the higher side of things for the domestic M6 copper. So that's it from our side. Thank you very much for watching. Have a pleasant day and a week ahead. Thank you.